If you've ever watched the financial news, you've probably seen headlines like these: "Markets fall after the Federal Reserve makes comments," or "Stocks plunge during central bank press conference." As a result, sometimes the reaction is wild. Stocks nosedive in minutes, the currency market swings wildly, and bond yields shoot up everywhere. Even when the economy is doing fine, a powerful official's one sentence can trigger a panic or boom in the markets, simply because of the impression it creates. So why do markets react so strongly when central banks speak? Today we are going to explain the fundamental reason behind these responses and how a few well-chosen phrases from organizations such as the Federal Reserve or the European Central Bank can cause financial markets around the globe to tremble. To understand this, we need to start with something fundamental. Central banks pretty much set the price of money in an economy, what we all know as the interest rate. And it affects almost everything in the financial system, like how expensive it is for companies to borrow money, how much households pay in mortgages and loans, how governments handle their budgets, and even how investors figure out what a stock or a bond is worth. When interest rates go up, borrowing becomes more expensive. Companies make fewer investments. Consumers spend less. During this time, the economy tends to slow down, and stock prices often decline. But when interest rates fall, the cost of money decreases. That means investing becomes easier for businesses, and consumers can borrow more. As a result, the markets usually respond positively. That's why every time a central bank even drops a hint about raising or cutting rates, investors everywhere take notice and start reacting, sometimes frantically. And that is when markets begin to move. Here's something important to remember about financial markets. Financial markets don't really care about what's happening right now. What matters is what investors think will happen next. So investors are constantly trying to answer questions like, are interest rates going up next year? Is inflation going to drop? Is the economy heading for a slowdown? Central banks have a ton of influence here. The way they talk about the future, what they call forward guidance, can set the whole tone. Just a tiny change in the language of a central bank statement can change everything. Add or drop a single word, and suddenly investors might see a whole new direction for policy. That's why investors look at every word of speeches, press conferences, and meeting minutes, because those clues help them guess what will happen next. When markets look at what the central bank says, they usually want to know whether the bank is sounding hawkish or dovish. If the tone is hawkish, the central bank is clearly worried about inflation. They'll likely keep raising interest rates, tighten financial conditions, and dial back on stimulus. That kind of talk usually knocks stock prices down and sends bond yields up fast. If the tone is dovish, the central bank is signaling it wants to support the economy. That means lower interest rates, more stimulus, and easier access to credit. Markets love that, so in this case, you'll often see stocks climb. The real problem happens when investors expect one thing but hear another. If traders expect a dovish message, but the central bank sounds hawkish, in that case, markets can drop almost instantly as investors rush to reposition their portfolios. Central banks don't just influence markets with interest rates, they can also influence markets by controlling the flow of cash through the financial system, which is known as liquidity. One of their strongest moves is quantitative easing. This is when central banks buy large amounts of government bonds or financial assets that pumps money directly into the economy and drags down long-term interest rates. This usually makes asset prices climb, pushes investors to take on more risk, and gives a nice boost to financial markets. But when central banks flip the switch and start quantitative tightening, things can get a bit rough. Investors pull money out, and the markets feel it, sometimes right away. Technology is another reason why markets move so quickly these days. Many trading companies now use algorithms that scan central bank speeches in real time. These systems search for certain phrases. As soon as one pops up, automated trading systems can trigger buy or sell orders within milliseconds. The market can react before human traders have even finished reading the statement. This kind of automated trading can make the market more volatile and make reactions seem even more dramatic. Leverage is another thing that can turn a small market move into a full-blown sell-off. Many hedge funds and institutional investors borrow money to increase their investment exposure. Sure, it pays off when markets climb, but if things turn south, they get hit with margin calls. Basically, they're told to sell off assets fast to cover their losses. This rush to sell sets off a chain reaction. Prices drop, which forces more selling, and then prices fall even further. Before you know it, what started as a small reaction to a speech can suddenly look like market panic. Finally, decisions made by central banks don't just affect one country, they have an effect on the whole world economy. The US Federal Reserve is a good example of this. When the Fed raises interest rates, many investors around the world move their money into US assets because they pay more interest. That makes the dollar stronger and can cause money to flow out of emerging markets. Countries that owe a lot of money in dollars may suddenly have to pay a lot more to borrow money. So, a policy change in Washington can quickly affect markets in Asia, Europe, and Latin America. Most of the time, markets can deal with bad news. If investors expect a rate hike, prices usually adjust gradually. But uncertainty is different. When central banks send mixed signals or say something unexpected, investors start doubting their predictions. And with trillions riding on those guesses, even a few surprising words from policymakers can send shockwaves through global markets. So, the next time you see the markets go crazy during a central bank press conference, keep this in mind. It's not just about the speech itself. Those words carry weight. They hint at shifts in interest rates, the flow of cash, and where the global economy might head next. So now I'm curious, do you think central banks have too much influence over financial markets? Do you think this level of control is necessary to keep the financial system stable? Let me know your thoughts in the comments. If you want more breakdowns like this, make sure to subscribe.